Good afternoon. My name is Brijesh, and in this video, we will see why is the stock market rising even when the economy of the country is slowing down. We saw stock market seem to remain intact as the Sensex rose from 26,000 level in March to above 49,000 as on 28th March. So, as many economists and analysts are amazed by the mindless bullish sentiment, I believe it makes sense of this run up in the stock market in India. Basically, the economy and markets can move in different directions, and there are different factors which affect both of them. See, there are some factors that are affecting both of them. So, we can say if we talk about government policies, economic conditions, growth momentum, sectoral outlook, or easy availability of cheap credit and customer demands, these type of things affects both stock market and economic growth. But the financial markets and the investors are also often influenced by the global developments. So let's say there is an expansion plan of central bank balance sheet, and or there are easy money availability, falling rates, or global fund flows. The markets and investors are often forward looking. So whenever there is a bad news, investors get their stocks discounted quickly, and also their focus shift to the remedial actions taken by companies and governments. So although the things are going slow down, basically investors always look over the future outlook of government policies. So this kind of things leads to an increase in security prices, as we saw previous also. So when we talk about the stock markets, we are talking mostly about the organized formal corporate sectors. Whenever this kind of disruptions happens, even in the past, we have seen that the organized or the formal corporates actually gain market shares. So if we will see the data, it also makes kind of sense because see the first quarter numbers when announced by the companies just after lockdown last year in India, that shows drop in sales, but their profitability was still quite strong. Reason, if you will ask, reason were all those companies fearing the very worst, they already cut their cost. So they cut their advertising spending, they cut salaries, and in some cases they also reduced manpower. So therefore, while the top line degrew, operating profit did not degrew many much. So which means operating profit fell much less. I believe that now, as the recovery comes back, corporates are not going to give away all the cost benefits that they have achieved. So even if we say work from home thing, there was many cost cutting that was happened because of that. So even with an uneven recovery, I think corporate, especially the larger ones, will still be doing well. Also, the liquidity, both global and local, is playing a part in way the market is moving. Many of us thought that a bank will be settled with very heavy credit cost and non-performing assets, and now, making no mistake, credit cost will still be high, but it will not be as weak as everyone expected earlier. And another positive in the private sector banking space, and that is the fact that most of the major private banks have been able to raise capital in this period. So, which give confidence that they are prepared to take the shock. And if not others, well capitalized banks, at least with abundant liquidity, can go out and lend once the pandemic is over. And there are IT or pharma stocks, and then there are fairly large number of auto, ancillary, and industrial companies which cater to the global demand. I believe the global economy, particularly the US and Europe, has or rather how will recover sooner because of the fiscal stimulus and monetary stimulus that they are seeing. Although now there are second wave of COVID also, but when they will be recover, these globally oriented companies looks pretty decent, and that part is also holding up the market. Also, from India's side, government is making efforts in pushing formalization, digitization, and manufacturing. That is going to stand the country in good stead. And when it comes to attracting FIIs and FDIs, as and when the effect of pandemic starts waning. So there is a huge amount of fiscal and monetary stimulus flushing around, as we have seen in this budget also, and even in the previous year's budget. As and when the globally economy sees a bit of recovery, bond yields will also move up. As when it happens, allocation happens to emerging markets, and within emerging markets, China and India are the only markets which can take this kind of allocation. And with US dollar weakening, chances of higher allocation to emerging market, that is still much higher in that.